Have you ever added someone to your bank account because you trusted them completely? Maybe it was your husband or wife. Maybe it was your son or daughter who helps you pay bills. Or maybe you simply wanted someone to have access to your money if you were ever in the hospital. For millions of American seniors, that decision felt responsible. But what if I told you that one signature at the bank may have given that other person more authority than you ever intended? Not because the bank did anything wrong, not because someone tricked you, but because many people never fully understand how a joint account actually works until a problem appears. And by then, changing it can become much more difficult. In today's video, we're going to look at 3 joint account rules every senior should understand before making changes to a bank account or adding another person's name. We'll also talk about one mistake that creates family conflicts, one banking option many retirees don't know exists, and one 5-minute account review that could save you from expensive problems later. So make sure you stay until the end, because the 3rd rule is the one that surprises most people. Let's begin with rule number 1. Many seniors believe that adding someone to a bank account simply allows that person to help manage bills. That sounds reasonable. But in many cases, a standard joint account does much more than that. A joint account generally means that both owners have access to the money according to the account agreement. Depending on the type of account and state law, each owner may be able to withdraw funds, write checks, use a debit card, or make other transactions without asking the other owner first. Now, that doesn't mean every joint account works exactly the same way. Banks have different account agreements. States have different laws. That's why understanding your own account is so important. Let me give you an example. Imagine Mary. She's 75 years old and has lived alone since her husband passed away. Her daughter Sarah visits every weekend. She helps with groceries, doctor's appointments, and sometimes deposits checks. One afternoon, Mary tells her banker, "I just want Sarah to help me if something ever happens." The banker explains that one option is adding Sarah as a joint owner. Mary agrees because it sounds simple. For years, everything works perfectly. Sarah never spends a dollar without asking. Then one day, Mary meets with an estate planning attorney. The attorney asks, "Did you want your daughter to help with your banking? Or did you want her to become a co-owner of the account?" Mary stops for a moment. She thought those 2 things meant exactly the same thing. They don't always. Helping someone manage money and making them a legal co-owner are 2 different decisions, and many people don't discover that until much later. That's why the first question every senior should ask is this: why am I adding another person to my account? If your goal is convenience, there may be another option. If your goal is emergency planning, there may be another option. If your goal is making sure your bills get paid while you're recovering from surgery, there may also be another option. Many banks can explain choices such as a payable on death (POD) designation, or in some situations, a durable financial power of attorney. These options serve different purposes than a joint account, so it's worth asking which one best fits your needs. Now here's another question. When was the last time you reviewed your bank account agreement? Not 5 years ago. Not when you first opened the account. I'm talking about today. Most people never read the updated account agreements their bank sends in the mail or posts online. They assume nothing important has changed. But banks occasionally update their deposit account terms, and it's always a good idea to understand the current rules that apply to your account. A simple phone call can answer that question. Ask your bank, "Can you send me the latest account agreement for my joint checking account?" That document explains how your account works today, not how you remember it working years ago. Now let's move to the 2nd rule. This one surprises thousands of families every year. It doesn't happen while you're paying bills. It doesn't happen while you're grocery shopping. It usually happens after one account owner passes away. Imagine a father with 3 children. He adds only one son to his checking account because that son lives nearby and helps with errands. His will clearly says everything should be divided equally among all 3 children. Years later, after the father passes away, the family expects the money in the account to be shared equally. But that's not always how jointly owned accounts work. Depending on the account's ownership terms and state law, money in a joint account may pass directly to the surviving joint owner instead of becoming part of the estate that is distributed under a will. That one misunderstanding has created countless family disagreements, not because anyone was dishonest, but because nobody understood how the account had been set up in the first place. That's why financial professionals often recommend reviewing both your estate plan and your bank account ownership together, because they should work together, not accidentally create different outcomes. And believe it or not, the third rule is even more important. It has nothing to do with inheritance. It has nothing to do with writing a will. It involves something that can happen while both account owners are still alive. And in some situations, another person's financial problems could create unexpected complications for a shared account. That's exactly what we'll cover next. Now let's answer the question we ended with. Can another person's financial problems affect a joint bank account? The honest answer is, sometimes they can. And that's exactly why understanding your account matters. Let's look at another example. Imagine Robert is 73 years old. He worked hard his entire life, paid off his home, and saved carefully for retirement. A few years ago, he added his adult son, Michael, to his checking account because Michael lived nearby and could help if an emergency ever happened. Everything worked perfectly, until one day Michael experienced financial trouble. Suddenly, Robert found himself asking questions he had never considered before. Does the fact that Michael's name is on my account change anything? The answer depends on several factors, including the type of account, the laws in your state, and the specific legal situation. That's why it's never a good idea to assume every joint account is treated exactly the same. The important lesson isn't to panic. The lesson is to understand your own account before an unexpected situation arises. That's why many financial professionals recommend reviewing your account every few years, especially after retirement, after losing a spouse, after getting married again, or after adding another person to your account. Life changes. Your banking decisions should be reviewed too. Now let's talk about another mistake many seniors make. Some people put every dollar they own into one joint account: their Social Security, their pension, their savings, their emergency fund, everything. At first, that seems convenient. Only one account to manage, only one debit card, only one monthly statement. But many financial professionals suggest keeping emergency savings separate from everyday spending whenever it makes sense for your situation. Why? Because if an issue ever affects one account, not all of your money is tied up in the same place. Think of it this way. If your refrigerator stops working, you don't throw away the entire kitchen. You fix one appliance. The same idea can apply to your finances. Keeping some separation between daily spending and long-term savings can make managing your money easier. Now here's something else many retirees never think about. What happens if you simply become sick for a few weeks? Suppose you're in the hospital recovering from surgery. Someone needs to pay your electric bill, your insurance premium, your property taxes. Many people immediately think, I'll just make my son or daughter a joint owner. But remember what we discussed earlier. A joint account isn't the only option. Depending on your needs, your bank may explain other tools that allow someone to help with financial matters without making them a co-owner of your money. That's why asking questions before signing paperwork is always a smart decision. Now let's move to something that affects nearly everyone watching this video. Scams. Every year, criminals target older Americans because they know retirees often have savings they've spent decades building. Some scammers pretend to be from your bank. Others claim they're from the government. Some even say your account has been locked because of suspicious activity. Then they pressure you to act immediately. They might tell you, "Move your money into a safe account. Read me the verification code we just sent. Confirm your debit card number." Stop right there. A legitimate bank will not call unexpectedly and pressure you to move your money to another account because of an emergency. If you ever receive a call like that, hang up, take a deep breath, then call your bank yourself using the phone number printed on the back of your debit card or listed on the bank's official website. Never trust the number provided by the caller. That one habit has protected countless seniors from financial fraud. Now let's put everything we've learned today into one simple checklist. First, know exactly who owns every bank account you have. Second, understand why another person's name was added. Was it for convenience, emergency planning, or because you believed it was the only option? Third, review your current account agreement. Bank policies can change over time, and it's worth understanding how your account works today. Fourth, if you're unsure whether a joint account is still the best choice, schedule a meeting with your bank. Ask questions. There's nothing wrong with saying, "Can you explain my options in plain English?" A good banker should be happy to do exactly that. Finally, talk with your family. Many financial problems don't begin because someone acted dishonestly. They begin because everyone assumed something different. One person believes the account belongs to everyone equally. Another believes they're only there to help. Another believes the will controls everything. Those misunderstandings can often be prevented with one honest conversation. Before we finish, I want you to remember one thing. This video isn't telling you to close your joint account. It's not saying every joint account is a bad idea. For millions of married couples, joint accounts work exactly as intended. The real message is much simpler. Understand what you own before life forces you to. You've spent years, maybe decades, building your retirement savings. Taking 30 minutes to review your bank accounts could be one of the smartest financial decisions you make this year. If today's video helped you better understand joint accounts, let me know in the comments. Do you currently have a joint bank account with your spouse, your children, or another family member? I'd love to hear your experience, and your story could help another viewer make a more informed decision. If you found this update helpful, don't forget to subscribe to Robert Preston Updates and turn on notifications so you never miss our latest videos covering Social Security, retirement, Medicare, banking, and important financial updates for America's seniors. Thank you so much for watching. Stay informed, stay protected, and I'll see you in the next video.